Well, thank you, Paige, and hello, everyone. This is Robert. Welcome to today's webinar, Reserve Studies 103, the Funding Plan. Here at Association Reserves, our job is to help you plan for the inevitable major expenses facing your association. You need those properly sized reserve contributions to perform your reserve projects on time, minimize the expense that comes from deferred maintenance, maximize pride of ownership, and maximize property values. This is the outline we're going to use today to talk about reserve contributions. And at its simplest, those reserve contributions are what's necessary to offset ongoing deterioration, so you'll have the funds when you need them. Now, there's a little more to it, and that's exactly what we'll take the time to go into today. The problem we're addressing is how much reserves to responsibly set aside. And that's the big question every board asks every year. What do I do now? So I'm glad you're with us today because we're going to clarify the influences and the decision points, building your knowledge so you'll be able to confidently lead your association successfully into the future. Now, I show this slide to illustrate the confusion around reserve contributions. What you see on screen are just 4 possible contribution rates that you can calculate from one set of reserve components. And you'll see that they're significantly different. And you're right to wonder how that can be. Usually there's only one correct answer to a question. But even though there's 4 here on screen, by the end of our time here today, I think you'll get comfortable that there is indeed a just right for your association. So let's start with the biggest influence. What do you think is the biggest influence on your reserve contribution rate? Got an idea? The largest influence on the contributions are the components at your association, and they're found on the component list. The variety, quantity, and condition of your common area assets define those upcoming expenses, and those expenses are the ones that your contributions are designed to offset. All the rest of the reserve study is built on the foundation of the reserve component list. And here's the sample reserve component list Ian and I will be using today. Probably shorter than most, but it'll do for the purpose of today's webinar. I expect that you've all seen something like this before. Each component has a description, a useful life estimate, remaining useful life estimate, and a current cost estimate. And because of its importance, we dedicate an entire webinar to the reserve component list. You can find that Reserve Studies 101 webinar either on our website or on YouTube. And it's on the basis of that component list that we calculate reserve fund strength and the funding plan. Our Reserve Studies 102 webinar, also available on YouTube and our website, is an overview of all those calculations and the entire financial analysis side of the reserve study. And those calculations of reserve fund strength are important because they give us guide points along the way into the future to help our decision-making about risk management, namely, how much margin against special assessments is going to suit the style and temperament of your association members. And that brings us to today, Reserve Studies 103, where we focus entirely on your funding plan, or contributions, you might say. The size of those contributions are going to be influenced both by the component list and the association's starting reserve fund balance. Meaning, are you starting from a position of strength or a position of weakness? And all the concepts we share with you today come from National Reserve Study standards, which have been in place and guiding the entire reserve study industry since 1998. So we get to the question, what are we shooting for, or what are we trying to accomplish? It's important to know your destination before you set out on a journey. So this is our starting point, the expenses facing your association. Component list has been established. And the question is, what's it going to take in the way of reserve contributions to provide for these upcoming expenses? So Ian, why don't you take it from here?
Thank you, Robert. And I'm glad to be with you all today to go through this topic of reserve contributions and how they're calculated. Just to warn you in advance, for a single year, I'll probably call them contributions, but on a multi-year basis, you'll probably note that I call it the association's funding plan. In the last slide, you saw very irregular expenses, but your assessment income stream is fundamentally smooth. So the challenge is to set up a smooth income stream to reserves that provides, for all these irregular expenses. And the first important concept I want to reinforce is just what Robert shared at the start. The reserve contribution should be designed to offset steady, ongoing deterioration. While the actual expenses may be irregular, the value of ongoing deterioration is steady. So that's a key concept to start with. So it's going to be a risk management issue. Rather than just barely getting by, which invites a lot of risk, and by that we mean, special assessments. It is likely in that the association's best interest to have a strong reserve fund. But the question is still, how much is enough? The three National Reserve Study Standard Funding Plan goals are full, threshold, and baseline. To be fully funded is a conservative goal where the reserve fund is strong and the special assessments are very rare. The opposite of this goal is the baseline fund your reserves, which is the lowest goal defined by National Reserve Study standards. Baseline funded associations commonly experience special assessments. Pursuing a full funding goal looks like this. Wanting to have your cash in reserves, the green line, eventually grow to match the value of the reserve component deterioration at the association, which are the violet bars that you can see. You can see the red line is what the association is currently contributing. Continuing their contributions will completely have them run out of money in about 10 years. With exactly the same expenses, this is what pursuing a baseline funding goal looks like. Lower contributions that theoretically keep the reserve cash positive, well below the cash balance carrying a full funding for associations. They get very close to zero in about 15 years. And it's at pitch points like that where the special assessments occur when things don't go exactly as planned. So we're going to talk about risk today. Higher risk of special assessments for baseline funding associations and the lower risk for full funding associations. Note how measured of percent funded special assessments are close to zero for associations above 70% funded. There is a measurably lower risk of special assessments with a strong reserve fund, but that is a choice. I want to get back to that concept of the cost of ongoing deterioration. It may or may not be displayed in your reserve study, but it's a pretty simple concept. Going back to the component list Robert showed earlier, if you take each component's cost and divide it by its useful life, you'll find out its fractional deterioration each year. Going halfway down the chart, you see the asphalt seal coating, $5,000 every 5 years. The math is easy. 5,000 divided by 5 years means that it's deteriorating at about $1,000 per year. Effectively, you'll need about $1,000 of reserve contributions to keep up with the pace of deterioration for that component. For this component list, doing the same calculation for all the components tells you the components are deteriorating at a rate of $20,170 per year. Just offsetting your deterioration won't build or deplete your reserve fund strength. Whatever it starts with, it'll stay at a high level of strength for years with just little variation. But if your reserve contributions are above the rate of deterioration, you will be building reserve fund strength. This is an example of how slightly higher reserve contributions can build your reserve fund strength over a period of years. However, the opposite is true. If your contributions are less than the rate of deterioration, those lower contributions will drop your reserve strength, but will also increase the risk you'll have to make up those contributions with an unplanned special assessment. There's really no free lunch. So what we find is that for every association with a stable component list and reasonable estimates for interest and inflation, there's a narrow band of contributions that will be just right a reasonable and stable plan that provides sufficient funds for those upcoming expenses. Maybe a little more or a little less based on your funding goal. Contributions that are just right for your association.
Thanks, Ian. That just right contribution description starts to remind me of the Goldilocks and the Three Bears story. Well, that was a nice summary of different funding goals. And let me just check in with the audience. If you do have any questions about anything that Ian has brought up, just make sure to type them into the comments section, and we'll get to those at the end of today's session. Well, Ian, it was good to learn that there's actually a pretty narrow range of reserve contributions that are best for every particular association. Now, but because those contributions are driven by the needs and the ongoing deterioration of those components, I guess, that's not too surprising that there's one kind of narrow solution. With a set of expenses, you need a set of income to offset those expenses. So it's really not too surprising. But now, tell us about how an association gets there, how their reserve contributions are actually calculated.
Yeah, absolutely, Robert. Thanks. The goal is to set aside enough funds, like we said, to offset deterioration and to prepare the association for these inevitable upcoming expenses. Sometimes it seems like a wheelbarrow of money.
Or a bulldozer full of money.
Exactly. We're guided in this by National Reserve Study standards that tell us that any funding plan should provide sufficient cash, be stable from year to year, be evenly distributed over the ownership over the years, and be fiscally responsible. So those are kind of what we would say the rules of the game. There are two ways to compute the contributions. You can think of them as two different tools. Usually, this is a choice made by, in the background, by your reserve study professional. But in some areas of the country, state law gets involved. This choice of computational tool is significant because even with the same component list, starting balance, and same interest and inflation assumptions, contribution sizes can differ 50%, and that's pretty common. Follow along and I'll explain. So the component method looks at each component individually and calculates a reserve contribution for each one. So think of it as an up and down method. And calculating all the individual pieces and summing them up at the bottom.
Line by line by line by line by line, just all the components individually.
Exactly.
Okay.
And then the cash flow method doesn't look at individual components. All it looks at is the reserve expenses over the years. These expenses are the reason that the reserve contributions are being collected. As you can see, you don't know what makes up for all of these expenses from year to year. Painting, roofing, asphalt, pool resurfacing, whatever it is. It's just a reserve expense. So you can think of this as a left to right method.
So it's the same components, just kind of two ways of looking at it.
Yep, they're all grouped together in this case. Let me show you a little more detail about the component method and its nuances. By nature of its name, the method is based on the computations done on each individual component. Because each component stands on its own merit, each component needs to get funded quickly enough to be prepared for its next occurrence. Let me show you what I mean by that. This is the component list we've been working off for this webinar. By focusing on the individual line items, looking at the highlighted cells, you'll see that the component method will require the pool furniture to have $4,600 in the initial year to pay for the bill for the pool furniture. The asphalt seal and the asphalt resurface funds need to each have $5,000 and $25,000 respectively within 2 years. And the building repaint fund will need to have $50,000 by next year. Getting enough cash into the reserves for these 4 individual funds while still funding for all the others will require some high reserve contributions in the short term. If you actually do the calculations year after year, presuming the association follows the plan, this is what a multi-year funding plan will look like. high in the first few years while the association is in a steep catch-up mode, rapidly strengthening its reserve fund as it prepares for those near-term components while funding all the other components. After those initial expenses, contributions drop down to a stable rate of deterioration level, because after the expenditure, those funds have the entire useful life of that component to collect enough for the next replacement. So with the component method calculations, the normal profile is to have high contributions for a while in the first few years and then dropping down to lower contributions later. But unfortunately, those initial recommended contributions are high enough that the association never quite gets caught up. So again, I want to make this clear for you all, and it's an important concept to understand, this association's catch-up mode. Contributions calculated with the component method will be high for a few years. So again, throughout this whole webinar, if there are any questions or any further clarification, please type it into the text box and we'll be happy to go over that at the end. Because every component stands on its own and each has to get ready for its own upcoming expense, the component method only pursues the conservative full funding goal. So while it's not very flexible, only directing the association towards a conservative full funding goal, the advantage of the component method is that the calculations are very simple. It's just a matter of line by line, simple calculations that could easily be done with a calculator. But because the average association is underfunded, component method calculations for underfunded associations yield high contributions in the first few years. And that makes the component method funding plans a tough pill to swallow for most associations. Okay, so let's shift gears for a second to the cash flow method. Remember, nothing has changed with respect to the components. We're funding the exact same expenses. This way of calculating reserve contributions focuses on the annual expense totals, not individual components. So for a 30-year plan, there are 30 expenses to deal with, no matter if you have 5 or 55 components. So in looking at the expenses over the years, the cash flow method doesn't care if it's a year expenditure is for one project or a combination of projects. It's just how much reserves are necessary to pay the expense in a given year. It's kind of like planning for a flight plan for an airplane over like a mountain range, preparing to fly over the peaks along the way. And analysts have the flexibility to create a funding plan that barely crosses the mountains, with more of a conservative plan that crosses some additional margin. So again, just creating this funding plan. And because of its flexibility, you can design a nice, smooth funding plan that floats upwards with inflation, so current and future owners effectively pay the same inflation index contributions, all while providing sufficient funds. Now again, let's contrast that with the component method profile I showed you from a moment ago, where contributions start high and then drop later. Here's the cash flow chart again, now showing the average of contributions over the years in yellow, again with that steady climb. Here's the component method chart showing the average contributions over the years in yellow. Due to the funding being the exact same components, the amount of cash going into reserves over the years is very similar. Other things being equal, only the profile is different. Again, we haven't changed any expenses. This is why there can be such a difference between cash flow and component method reserve contributions. It's not the amount of cash going into the reserves over the years. It only looks like a big difference when you only look at the first year.
Yeah, Ian, can I break in here? Let's look at the component method. It's what, $5,000 per year, or excuse me, $5,000 per month. And I'm going to go back a slide down to $2,000 some dollars a month. That's a big difference. In this case, it looks like a doubling, and it's all just the first year difference? Because that average is what, $3,700 if you average it out through the years?
Exactly. They come out to about the exact same average. It's
Yeah.
just how you get to the end goal.
Right, because it's exactly the same expenses over a 30-year period.
Exactly.
Cool.
So here's another way to look at the difference between the two, an accounting issue. Remember, in the component method, the reserve fund is divided into separate accounts for each component and may look something like this. Unfortunately, the case too often happens that the association's needs, for argument's sake, funds for the asphalt and fencing, and some reason the funds allocated to those components are now underfunded. So the association is forced into reassigning cash from one account to another. It's a lot simpler if you break it down, break down the barriers, making sure the same cash is available for all scheduled reserve projects. The cash flow method also totally eliminates the accounting task of tracking funds in each separate account and inevitably reassigning those funds from one of the components to another when and if it's necessary. It's kind of like having one reservoir or pool of money. And this is why the cash flow method is sometimes referred to as the pooling method. Remember, both methods fund exactly the same expenditures. This flexibility in the cash flow method allows the user to create more or less margin, meaning it can be used to achieve any of the three National Reserve Study Standard funding goals: full funding, threshold funding, or the barely cash positive baseline funding goal, just by adjusting more or less the funding going into reserves. So the cash flow method is nice and flexible, but as too often it has been used to design contributions pursuing a risky baseline goal that runs the reservoir dry, as we were talking about earlier.
I'm sorry, I'm following along with you, and I'm loving what you're saying.
Absolutely.
You're making it real clear.
With the first year of contributions, they kind of look ridiculously small compared to the component method calculations. Looking at just the first year, it's an unfair comparison. Over the years, the net contributions between the two are the same because they're funding the exact same expenses. But when comparing only the first year, the cash flow contributions are regularly much lower.
Ian, I think that's the key. And you've made it very clear that they might be funding or looking at it two different ways, up and down versus left and right, but it's exactly the same expenses. Over the years, it's going to be exactly the same contributions, but it's kind of that unfair first year only comparison that gets people all pushed sideways. Is that kind of how you see it?
Yeah, that's absolutely right. It's how we're going to get to the end goal and trying to do the best we can to spread those costs out, over many years.
Right. And that's bringing back the National Reserve Study Standard funding principles that you want sufficient funds, budget stability, what was it, equitable distribution, smooth distribution over the years, and then something fiscally responsible. So it's guided by national standards, and you can get something that looks a little bit smoother with that cash flow method.
Yep.
It all makes sense. Okay, so it's now time to bring this webinar to a conclusion, wrapping up all that we've discussed now about the responsibilities, the goals, and the calculation methods. So let me turn it back over to Ian.
Okay, and so right, Robert, as we were talking about before, this is all we do day after day, guiding our clients down the trail, as you can see in this picture here, just towards the future. Having an association reserves project manager on your team means you have someone familiar with the tools, methods, and influencing factors, someone who sees the multi-year perspective, and someone who can design a funding plan that's just right for your association. Remember, the cost of deterioration based on your components is real and inevitable. The ongoing deterioration for these components are going to fundamentally define your reserve funding needs. cash flow or component method calculations are just different tools used to find what is needed in your association. The ongoing cost of deterioration of your common area components is just as real as any other bill the association faces, and no one has the magic to lower those contributions below what is needed. There is no magic solution. Over the long term, if you don't make contributions equal to your cost of deterioration, you run your association right into a wall that we call a special assessment land. What we've learned is that the cash flow method gives us the flexibility to craft a custom funding plan that is easier for first-year clients to implement, is more stable through the years, and it is inherently more fair for owners over the years. And it allows enough customization that we can match it to a particular physical or financial need of our client. The big picture is looking at the data from preparing thousands and thousands of reserve studies in all 50 states, is that the associations need to plan on setting aside between 15 and 40% of their total budget towards reserves. Many associations find that their just right amount of contributions is right around 25% of their total budget. Now, even if that might seem like a big number, I'll argue that reserve contributions are not too expensive. For the average condo owner, it boils down to just a few dollars a day to pay their reserve contributions. That's basically just about the amount of a cup of coffee.
That's fantastic. Well, thanks, Ian. You've made all the issues surrounding reserve contributions understandable. We didn't get our calculators out. We weren't thinking about numbers. And you've made the hard lessons learned from 30 years of preparing reserve studies pretty straightforward. Now, while those reserve contributions for your association might look like a big number, you showed that to Wheelbarrow earlier, thinking that for a condo, it just boils down to something about the same cost as a cup of coffee, makes it sound very doable for your association. And I want to leave our audience here with a regular reminder that when you do discuss reserve contributions, don't describe them as for the future. That makes them sound like someone else's problem. So when you discuss reserve contributions at your association, make sure you're discussing them as just offsetting the ongoing deterioration bill around you. And that's a pretty simple bill, or like you said, that's pretty simply just a bill that needs to be paid.
Exactly, Robert. That's the mindset we want to have our clients in, is that we are paying these annual bills that are in the form of deterioration. And just remember what you're trying to accomplish: providing for the predictable, inevitable needs of your association in a stable, fair way so that you can maintain the property and maximize property values. And when you do this as a board member, you keep your liability exposure to a minimum.
Well, thanks, Ian, and thank you everyone who has joined us today. Thank you for attending. We covered a lot of ground, but because of our limited time, I want to leave everyone with some additional resources. If you go to our website, www.reservestudy.com, you'll find written and video resources under our resources tab. And if you'd like us to help with your association, by all means, click the request a proposal link that you'll find at the top right of our homepage. And if you search for our reserve study videos on YouTube, consider giving them a like and subscribing to our channel. Or if you want something on your desk or a bookcase that summarizes major reserve study concepts, exactly the kind of things we've talked about today, consider ordering our book, Understanding Reserves. You can get a single copy straight from Amazon or bulk orders from our website. And remember that perhaps one of our best resources, our online reserve calculator, we call UPlanet, it allows you to test different funding plans, different expenses, so you can see, if you like, what happens. You can actually see for yourself, making those informed adjustments to your professional reserve recommendation. Access is free with every professional reserve study from Association Reserves. And if that whets your interest, make sure you join us for our next free webinar. That's on June 28, when we'll have a hands-on demonstration workshop for all our clients and prospects. And I'm sure you'll be impressed. It's a brand new way to view your completed reserve study where you can actually work with numbers and see what happens. They're not just numbers on a paper. And with that, brings us to the end of our planned curriculum for today. So I'll turn the microphone over to Paige, who will coordinate our Q&A time. Paige.